Hi, everybody. This is Friday, August 11th. So our stock chart of the day. Again, I'm doing this a few days before, but I don't think it really matters because it's a long-term orientated chart. Our stock chart of the day today will be uh, 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 Canadian interest rates, and we're going to look at one Canadian housing lender. So everyone knows that Canada has been. I've done charts of the day on Canadian housing prices. Today we're going to look at the interest rates. I actually have a family member this is really affecting. He's kind of a lower middle class type person, and these rates are really going to hurt him. So this is the most popular type of mortgage in Canada is a 5-year fixed mortgage, and you can see this is going back all the way to 1970. We can see the inflation and then the downward, basically moving interest rates till 2022. And, a 5-year mortgage rate went from 22% in Canada in the early 80s down to under 5%. Now, this is the fixed rate done by the Bank of Canada. And of course, banks can do their own rate. And we can see this has gone from, about 4 3/4 to about six and 3/4 at the moment. So we're basically gone up 2 basis points on a 5-year fix. But banks do a discounted 5-year mortgage rates, meaning that this is the actual rate that really you could get from a large cap bank in Canada. And we can see this only goes back to 2007, but we can see it's gone from pre-financial crisis about 6%, and it went all the way down to 1.4% in 2021. And many Canadians, that housing boom got even more fuel on the fire in Canada in 2020, 2021, when this went below 2%. And many people, this is when they bought a house, refinanced their house. Remember, this is only a 5-year fix, and we can see this is now gone to as of August 8th, 5.19%. And reason that these banks give out a lower than maybe the Canadian one is because they factor in inflation, income, where the short-term rates are, et cetera, et cetera, So, but you can see the issue is if you were someone who bought a house here, let's say you got 1.5 to 2%, and now you're over 5%, you're talking a 300 to 350 basis point increase. So let me give you an example. The average house price in Toronto is $1.5 million. So let's say, just for argument's sake, someone probably has a $1 million mortgage on that. Well, at 2%, you were paying $20,000 a year. So let's say you got two people, husband, wife. Let's say they make 6 figures. They're upper middle class, so they make 100,000 each. 20,000 a year in the interest payment, it's 10,000 each. Well, now all of a sudden that interest payment is going to be over 50,000 a year, 25,000 each. And let's say these people are just pure middle class, 60, 70, 80,000 each. After taxes, and you still have to pay the principal. This is why a lot of banks are going out to 80, 90-year mortgages on principal, because they cannot handle this sort of thing. That is lessening the principal payments to make up for the fact that the interest payment is so much higher. So this is equitable. This is kind of a subprime lower, and now it has gone completely nuts. You can see gone to all-time highs. They've increased, the amount that they've lent, the profits. Obviously they're making more because they are getting more interest. But at some point, when people can't afford these homes, can't afford these mortgages, it hits a company like Equitable, it hits all the big banks in Canada. So I just think at some point, and again, I think most people doing this in 2020 and 2021, 2025, 2026 becomes the years where this is really detrimental. And I can see, I've talked about, I think in 2024, we're going to see central banks cut rates, but I don't think we're ever going back to this. Now, we might go back to 3-4% on this, on a 5-year fixed mortgage, but we're never going to get back to the 1 or 2, which means that anyone who, and again, this is the most popular mortgage in Canada, who has to refinance is still going to be refinancing, 200 basis points, 250 basis points higher than the 2021 levels. So anyhow, that's something to watch out for. I think this is why we haven't seen the big bite, because again, in Canada, this is the most popular type of mortgage. And I know I have a cousin who's talked to my father recently. So obviously my father's nephew, he's he has a very middle-class job. So does his wife. And they're worried that because when their mortgage rate goes from whatever they did it at 1.5, 2% to the 5 to 6%, they don't know if they can afford their house anymore, you know? And I think this is going to be a predicament for many, many homeowners in Canada and the United States going into that 2025, 2026 period when, because I think a lot of people did that kind of shorter end on their fixed. They did that 5 year because that's the part where you're getting rates almost like the short end. And, but it's still pretty far out. It's 5 years. So anyhow, that's just something I would like to show you. That's our stock chart of the day for today is or chart of the day today is the mortgage rate. And, just kind of looking, I don't think, unfortunately, Equitable has puts on it, but definitely I would be looking here. Just broke the high here. So maybe, you can see what happened in 2019 when it broke the high. So maybe this thing could zoom up to 90 to 100, but I would definitely be looking at this as a potential short at some point here. Especially as we approach that 2025, 2026 timeframe when people have to renew their mortgages in Canada.